Okay, welcome back. Sorry for this trouble because I didn't pay for the full version of it. Um, but we are about to finish soon, maybe in 20 minutes. So don't worry. Um, okay, please mute everyone. I'm gonna mute you. Okay, right. But using this aging method, you have to pay attention that you add these recoveries back, but at the same time, we assume that we have collect all the money, um, like this amount is paid out. So you have to decrease this again, recovery. This is different from the previous method. So the previous method, you add the recoveries, but here you add it back and then you subtract it. And then you get the ending accounts receivable. Okay, this could be a little bit, looks confusing. So we can just um, making a practice and we will have a better understand. So the question 6, Work on Water is the largest wholesaler of pots and pans in West Canada. Approximately 60% of the company's sales are made on credit, and customers have 20 days from the date of sale to remit payment. And the following information is available for the year end December 31, 2022. So account receivable, aggregately, we have 500,000, and the allowance for expected credit losses, we have 65,000, and total sales, we have 1 million. And payments on account received from customers, we have 52,000. Write-off accounts receivable, we have 80,000. Recoveries of bad debts during 2024, we have 15,000. So what is the question? Okay. The first one, work on water. Yeah, this recovers has to be the same amount because you we we know that this recovers has to be added back, but at the same time we assume that we collect all the money back, like this recovers was paid out, right? So if it's written in the context that this recovers is not paid out, then you cannot use the same amount, right? So this is the difference. But for all the practice that I have met currently up till now, it's the same amount. So it's better to write it here and subtract it. Okay. Right. So the first one, work on water provides for expected credit loss using either the following calculation. The first one, 55% of credit sales for the year, or next one, 10% for current receivables and 25% of non-current receivables, which are overdue as at year end. So we can know that the first one is actually using the credit sale method, and the second one we have to use the aging method, right? So as at December 31, 50% of gross account receivable are current. And question 6A, determine the December 31, 2024 balance in credit losses and allowance for expected credit losses if the company used the percentage of credit sales method. Okay. So first of all, we have I recommend you to put the equation here. The opening AFECL plus rate losses for the year. And you subtract with write-off. And you plus recoveries. And you put this equation here. And please pay attention and just add one time this recoveries here. And you don't subtract it, right? And you put this equation here as a reminder for you. So what is the credit sales? Mr. Credit sales. So this is the total sales. This is the total sales. And as you can see here, 60% of the company sales are made on credit. Okay. So the credit sales will be 1 million times 60%. And then you got 100 something. Okay. And I said 5% of credit sales for the year will be credit losses. So starting from here, expenses for the year goes to 5%. And you got, how much is that? Okay, so we have this number. And we have this equation here, and we have these numbers, and just apply the numbers. What is this opening balance? You can find it here, right? This one. So you use this number, right? Plus credit loss for the year. What is that? You just calculate this. Right? You put this number here, and then you subtract the write-offs. What is the write-off? You can find it here. Right, this is the amount for write-off. Okay, you put it here, and then you have to add back the recoveries. The recoveries, this is the amount, and then you put it here, right? And then you do the calculation, which is altogether 6,000. That's it. So to add that expense balance. So just to remind you that this is the balance, the ending balance of this. And then let's have a look at the second one, question B. So still, I recommend you to put the equation here. So opening AR credit sales minus cash collection, and then subtract you add back the coverage. Because in the context it was not mentioned anything, so you assume that all this coverage that you collect the money back is paid off. Right? So here you subtract the coverage again, and then you're going to pending balance. And the account receivable. Okay, so what do we have? Opening balance of account receivable, right? We're gonna find this one, opening AR, which is here. 500,000. And then what's next? Credit sales. So credit sales we have already calculated. Is this number, credit sales? So put credit sales here. And then you minus the cash collections. It basically means the payments like on account received from customers is here. It's the same. It's here. And then you have to subtract the runoffs. So just get this runoffs system. I can show you again. The runoff is this number. And you put this runoff here. And then you recoveries. This is 0. So just equals to the ending AR, which is so this is the ending. It's not done yet, right? So this I said 10% of current receivables and 25% of non-current receivables are overdue at the year end. And at the end of December, 50% gross account receivable are current. So we have current AR, which is this amount, and you times 50%. And then you got, and for the non-current, it's the same, right? And but 10% is of the current receivables are overdue. So you put 10% here again. Then you got, what's this number? Sorry. 25% equals to so altogether you have to sum this up. Yeah, that's the answer for the second question. Why don't you add? Wait a minute. Okay, sorry, my bad. For ending AR, the question why I don't add this recoveries, right? So actually I'm using the second method. We have to add the recoveries and at the same time you have to subtract the recoveries at the same time, at the same amount. So there's no need if it's not set in the context that only a partial of the recoveries was collected. So we assume that we collect almost everything, all the amount, the full amount of the recoveries. So you add something and then you subtract something, so it's zero. So I didn't write it. I didn't write this. But for the first method, calculating the ending AF ECL using the credit sale method, you have to add this back. This is the difference. And you may notice, like when you write the equations, right? You add the recoveries and you subtract the recoveries. And for this one, you just add the recoveries. That's it. And what's the next question? Another answers will be the same, but don't you put it for like, oh yeah, I should put this like here, right? Let's do it like that. So you add this, that's it. Okay, this could be a bit confusing, and I recommend you to spend some more time onto this. Okay, let's move to the next one, inventory. So inventory are the tangible items that we held for sale by a business or use this to produce goods for sale for a business. For example, it could be raw material and the supplies. So inventory is a current asset as it is generally used within 1 year. And inventory is displayed on financial statements through inventory on the balance sheet, because you can see this inventory on the balance sheet, the left part, like within the assets, right? So it shows the remaining balance of the inventory. But at the same time, inventory is also used and reflected on cost of goods sold. But the inventory, I put the cost of goods sold here because it shows the amount of the inventory that is sold or consumed. Like this part goes to the cost of goods sold. So this one is the balance, and this one is what you consumed. right? Okay, so next part, cost of goods sold is also called COGS. So cost of inventory sold by your business. It is an expense. And therefore, it always debited. So there are two ways to calculate the COGS. One is to use the number of goods sold times per unit cost, then you get COGS. Another is, like you put the beginning inventory there, and you add on what you purchased, and then you subtract the ending inventory. This is what you used, right? So it's you add something and you use something, so you have the equation here, then you can calculate the COGS. And this inventory costing methods, there are three methods. One is specific identification. It's called specific ID. So each of the item is identified and recorded. And this is, used primarily for expensive items. And normally the questions will inform you which of the inventory is used when they ask you some questions. And the second one is first in, first out. It's called FIFO. So what does this mean? It means the earliest goods purchased at the earliest goods sold. Right, so this is very straightforward. First come, first in, first out. And another method will be weighted average. So in this way, COGS is based on the average cost per unit. So let's have a look at examples later. And so before we start, there's like a question here. If unit costs are rising, then FIFO provides the higher or lower cost of goods sold. Because costs are rising and first in, first out. So the first one, the previous one will be cheaper, right? So FIFO provides the lowest cost of goods sold and the highest net income. Right? And since the FIFO provides the highest net income and gross profit, so um, okay, sorry. And since FIFO provides the lowest cost of goods sold, and the cost is still rising, so it will consume the cheapest inventory, and the more expensive inventory will be left and remain. So the highest. So what you left is the highest ending inventory compared to the weighted average cost, right? So similarly, if the unit cost are declining, FIFO provides the highest cost of goods sold and the lowest net income and the lowest ending inventory compared to weighted average. So it's opposite, right? So let's have a look at the question. So this is the final question we have. So the cod father is a fish market based out of Seattle, Washington. On the first day, they purchased the 5 pink salmon for $8 each. This is labeled as fish 1 to 5. And on January 5th, they purchased the additional 5 pink salmon for $10 each. It's numbered as the fish 6 to 10. On January 10, they purchased an additional 5 pink salmon for 15 each. So this is labeled as fish 11 to 15. On January 12th, a customer purchased 8 pink salmon from the cod fighter for 20 each. So they finally sell something. And they choose the fish number 5, number 6 to 8, and number 12 to 15. So we are required to calculate the gross profit. Okay, so in order to calculate the gross profit, we have to know the revenue and we have to know the cost, right? So we're going to start with the revenue. The revenue, what do we have? We sell 8. This is the only day that we sell something, right? So we sell 8 fishes and $20 each, right? You put $20 here and you get 16. So I will omit the dollar sign to make it easy. And the cost. This is the different and tricky part. So for the cost, they choose number 5. And they choose the number 6 to 8. And what else they choose? They choose the 12 to 15. So how much is this? What's the cost? 8, right? Because number 5, you know, like by the time you buy it or you purchase it, it's 8. So different items have different price. So 6 to 8, what do you have? 10, right? So you get 3 fishes and you times 10. Then you have 30. Okay. And similarly, what you have here, you ordered 4 fishes. And each one is 15. And you times 15. And then you got 16, right? And then you have to sum this together. So total cost equals to the sum all of this together, 898, right? So the gross profit will be revenue subtract cost, right? So this is what I mean. Then it equals to 62. That's it. That's for a specific ID, but for FIFO, let's have a look. You got revenue here. It's the same, right? Because you sell the same, and it's the same for weighted average. Let's just put it here. And for the cost, first in, first out. So it should be number from the very beginning in consecutive orders. So it will from number 1 to number 5. Then you have 5 times 8. 5 fish. Let me just 5 fish, $8 each, and then you have 40. You're about to finish. And for the cost, for the next, how much list you order? 68. 628. 3, right? 3 times 10, and you have 30. Is that everything? Because first of all, you use all the 5 pinks in in this category, and then you use another 3, right? Okay, yeah, that's it. So total consumption is 8 fishes. So total cost will be total cost will be 70. And the gross profit will be different as well. Will be 90, right? Because you use the 160 minus the 70, you get 90. Right? So this is the revenue you have, and this is the revenue you have, the gross profit you have. And for the weighted average, the cost number 1 to 5, is the same. At we purchased 5 pink salmon for 8 1, so it's the same, $40. And number, oh sorry, so sorry, my mistake. So for the weighted average, you have to, list all the cost that you have, because after each of the transaction, inventory should be recorded and the price should be recalculated. So for the fish 1 to 5, and this is all their cost, and for the fish um, 6 to 10, and the price is 10, right? Oh, it's close. This price is 10, and then we got 50. For the cost, 11 to 15. So the cost will be 15. And then we got 75 by 6 to 10. Because here, fish 6 to 10, they have a different price compared to the first one. So for weighted average method, you have to, put all the cost here. Like this is the transaction for the first time. You pay for your fish from number 1 to number 5 with the price of 8. And second time you pay your fish for the number 6 to number 10, and then the price is 10, right? The price is 10 for each one. And for the last group, you are you're paying your fish number 11 to number 15, and this is the amount, and this is the price. The price is $15 each, and then this is the cost, right? This is all the cost you have. And then okay, and then you do the total cost. You sum this together. 65. And you have so many as the ending balance of your inventory, and how many fish you have here? You have 15 fish. So 1065 divided 15 equals to 11. That's the new price. That's the new cost of your fish. And then what is your total cost? It will be you sell 8 fish, right? Times 11 per fish. And then this is the total cost for you. And the gross profit is that the revenue minus the total cost. Let's do this way. I'm gonna make this smaller. So 116 minus the 88 equals to 72. Yeah. So this is the answer that if you use the weighted average one. So let me have a look. Is it describing perpetual or periodic way of calculating weighted average? I think it's the perpetual, because in perpetual method, you have to adjust your price each time you make a transaction. And in this way, you purchase the, like this is the first time you purchased, and this is second time you purchased, and third time you purchased. And before you sell it, and when you sell it, you have to identify the cost, right? So you sum up all the, ending, like the cost, sum up all the cost, and this become your ending inventory balance. And then for just identify how many units that you have, you do the math, use the ending balance divided by your remaining unit, then you have your new cost per fish. Okay. Right. This is how this was calculated. And as you can see, if the price is increasing, right, and then the FIFOs will have like lower cost, right? Because we just talk about this. We have less than 1 minute. Let me do another session. Please rejoin. I just have 5 minutes left, so yeah, please rejoin.